So now we turn to Asia, and we're going to start off with just looking at the U.S.-Alaska meeting that's happening, the U.S.-China meeting that's happening in Alaska. So when we look at the who's going to be there, and is this going to be something similar to what happened in Hawaii? So right now it's Yang, the top Chinese diplomat, Yang Jiechi, and Foreign Minister Wang Yi will meet U.S. Secretary Anthony Blinken and U.S. National Secretary Advisor Jake Sullivan in Alaska tomorrow and Friday. So these are, it's going to be a temperature-taking situation. They're going to look at where do we sit, what are our demands, what are our issues, and we don't have high hopes going into it. Let's put it that way. Like there's really not much that we expect to come that's going to be a net positive. So the question then becomes, well, why take the chance? Well, maybe because you can create a starting point with the new administration versus the President Xi after they finish their 5-year plan, and now they can try to address what they need to with the U.S. following the finalization of the Congress. So realistically, it's when we look at what could be optimistic, the one optimistic view is that officials from both sides are long-term diplomatic professionals. So the expectation is that the meeting will at least be cordial, unlike previous interactions, as we can all attest to with President Trump. We expect effectively zero concrete outcomes from the meeting, but if things surprise us and the meeting goes particularly well, it could potentially lay the groundwork for a Xi-Biden meeting later in the year. I don't think that's the case because what could happen is there is a concern that both sides simply use the opportunity to set out a laundry list of complaints and demands for the other. So these are going to be different components that we have to look at of, well, what is the tone, what comes out, what do both sides say, reading between the lines, the typical fun components of geopolitics. So then when we look at the NPC or the general activity or the legislative priorities in 2021 coming out of China for the Congress, here is what the biggest focus is going to be. The law on ensuring food security. We've written about that, talked about that countless times in terms of the shortfalls on food security or the rise of food insecurity. So, and especially when we talk in this segment about the amount of soybeans and corn that they continue to buy. Data security law as they crack down on tech. Henan Free Trade Port Law trying to increase the amount of transition. They did sign and ratify the RCEP deal. First country to do so, trying to put pressure on other countries. The futures law and stamp tax law, which we continue to see coming out of Hong Kong, and the way that they're essentially trading and activating their assets. Rural revitalization promotion law, personal information protection law. One is trying to get more people into the rural setting away from some of these other large cities, and then the personal information, again, speaking back to big tech. They also amended the anti-monopoly law, again, trying to focus on that big tech side and coming after not only just Ma and Alibaba, but the other entities as well. Scientific and technological progress law, the company law, enterprise bankruptcy law, agriculture product quality safety law, and then the administration reconsideration law. All of these things are trying to increase that control of the party across all walks of life. We've talked about this with, the rise of re-education camps and just trying to create a bit more of a centralized component as they have a bigger issue with stimulus and trying to get their economy back up and running. But when I say back up and running, well, Lee admitted that the economy still faces some headwinds. There is still a lot of uncertainty over the global economy's recovery. Small, medium, and micro-sized enterprises are still in the process of regaining their vitality. Lee also wanted to be clear that this does not mean the government plans to step in and juice growth. Going fast for a short while may not be stable. Only by walking steadily can we walk with power. So this is why and we'll go through the data points that recently came out, they continue to walk back a lot of their stimulus, a lot of their drive to essentially try to protect and or really garner additional debt because they're so over-levered at this point that they have to try to normalize some of their debt situations, which we'll talk about in a second. So as we said before, they're the first signer of the RCEP deal around 3 months ahead of schedule. The trade pacts can't go into effect until it is ratified by at least 6 of the 10 ASEAN or 10 Association of Southeast Asian Nations, at least 2 more of the non-ASEAN signatures, which include Japan, Korea, Australia, and New Zealand. Now, Australia and China are not exactly friends right now. Japan and China are not exactly friends right now. So you're relying on New Zealand and South Korea. And now North Korea is talking about, or at least we're getting intelligence on them potentially trying to, either launch something or test the waters. So clearly ahead of Alaska, President Xi told Kim, go do something. So how much is Korea going to be willing? So we need 6 out of 10 of the ASEAN and 2 out of 4 of the non-ASEAN, which is going to be hard to come by. China wants this deal done, and being willing to fast-track ratification was going to put pressure. China's legislator was never going to block ratification. So again, this is going to become a much bigger issue, especially given the issues that exist in Australia and Myanmar. So now that we're on the other side of that the 14th five-year plan, we have to look at what is being laid out for the manufacturing sector. So plans, if they want to make it more stable, but what does that mean? So it may not sound like much, but the manufacturing value add to GDP has fallen from 31.6% in 2010 to 27.2% in 2019. So they want to try to stabilize it at that 27%, but they're getting additional pressure because right now there's that bifurcation between a supply recovery and a demand recovery. Supply has been strong as they go into the international market, but the local demand has been under significant pressure, and that's something that we continue to see with retail sales and some of the industrial side. So policymakers are also aiming to build a higher quality manufacturing sector with the move into information technology. Said they want to. So we said China is a third-tier manufacturing power, citing Germany and the U.S. as examples of first-tier manufacturing. Again, technology, the quality of the stuff that we're putting out, it's high-tech. We're taking in semi-finished goods, making it into holistically better stuff. So to close the gap, the 14th five-year plan aims to slash costs for manufacturing companies by increasing the quantity and efficiency of industrial land use with a revamp of the allocation model, tilting equity investment and bond financing toward manufacturing and increasing the amount of medium and long-term loans, again, trying to adjust the structure of borrowing, lowering fees for ports, roads, and railroads, again, back to the port side, and allowing manufacturing companies to bid in market-based electricity transactions, trying to make things cheaper. Both the pandemic and U.S. sanctions are, again, that supply chain issue, which is why the Chinese policymakers don't want it to end up in a situation where they're dependent on another country for critical goods. When we talk about the Central Party school, called on officials to rein in excessive nationalism. So now we have the other side where the former executive vice president have said, you guys are doing too much re-education. We need to pull back a bit. So, but who is Yeating? He has served as a policy advisor to both Xi and his predecessor, and he thinks it is time for China to tone down its aggressive rhetoric. China should continue to expand, opening up, actively and prudently handle relations with major countries, and prevent the rise of domestic populism. Again, trying to keep people happy at home, minorities and the individual, but they're also saying this ahead of U.S. meetings. So again, trying to play both sides of the coin. Foreign Minister Yang Yi was present when he made his remarks, and we all know that he hasn't exactly said the nicest things, which again kind of counters some of the things that have been said in general. So then when we look at what turns out, the party doesn't take too kindly to competition in the public opinion game. So what does that mean? Alibaba has been under pressure. Beijing is concerned about their media assets, so government officials are particularly upset about the company's influence over social media in China and its role in an online scandal involving one of its executives. In February, posts about the scandal began disappearing from social media, including Weibo, drawing the ire of government officials. This isn't the first time Alibaba affiliate media was in trouble. So again, Jack Ma's decision to publicly mouth off to regulators last year created questions about his political reliability. And here we sit when his IPO was pulled. Pressure on him has increased. They're trying to now talk about getting rid of some of the issues in some of his assets. Again, these are going to be things that are going to only get worse when we look at some of the biggest issues on how tech and monopolies or large innovators are viewed. So now that we can shift a bit to Japan for a second. So weekly net purchases of Japanese foreign bond investments. So you can see that the Japanese are buying less of foreign bonds. That has started to increase a little bit out of the US, which we'll talk about in a bit. But we're starting to see Japan is decreasing the amount of foreign bonds that they're buying, and we're starting to see a little bit of a slowdown on that angle. And when we think about, well, what is happening here? So core machine orders in Japan have increased. They're still down 4.5% month over month. Expectation was down 5.5%. And then when we look a core year over year, they were up 1.5% versus the estimate of negative 0.3%. But when we start looking at industrial production, you can see that it's kind of flatlined with exports coming under significant pressure and imports starting to slow down a bit. Now, imports still remain elevated, which means that exports will bounce, but you can see that the import side and the export side still remain bifurcated, and it just means that there's going to be some additional pressure going forward. Now, the bigger issue for India, CPI continued to go higher, so the inflation is ratcheting up, with industrial production down 1.6% versus the estimate up 1%. So missed by 2.6%, just to give you an idea of what that looks like. Wholesale prices year over year up 4.17% versus the estimate of 4%. Again, inflation. Inflation is a big issue in India right now and is getting to become a bigger issue when you think about borrowing and how is India going to try to manage some of the things that are happening in the market. And that's happening as exports slowed. But on the positive side, imports are up. So we should see an export bounce on that level because imports have accelerated. So typically you see an import increase and then you start to see exports coming out. But India is also facing a rise in COVID cases in specific areas, which is going to limit the amount of industrial activity, which is why even though things have gotten a little bit better, we still have to be cognizant of some of the headwinds. Now, with all that being said, Tokyo office vacancies continue to go up. And this is leading more to when do we get some normalcy as COVID cases have gone higher in Japan, South Korea, and some of these other key nations. Now, South Korean export price index is now positive. So latest is up 0.2%. So to give you an idea, again, the export prices are continuing to drift higher. China prices got really high, so people started to look elsewhere. And now after looking elsewhere, you're starting to see price increases in these other regions, which is why we're starting to see this slowdown. I don't want to say contraction yet, because it's really that slowdown in just activity as we have, we still have some logistical issues, supply chain problems. So we're just going to get through some of that before we see some of these additional exports, which again, purchases, which will put pressure on global exports. So when we look at South Korea indicators, you can see on, looking at COVID cases, we had that spike back to the highs that happened at the end of February. Right now the government stringency index is still showing down, but it's actually going back up. Vaccine doses are still slow to get out there. And then when we look at public transport is slow. Movie attendance is flattish. You're just seeing some again, and we talk about it in the EIA show, we talk about it in the econ show, we're just kind of flat. We're not really getting to the next leg of recovery, which was why I'm more concerned for what Q1 and Q2 is going to look like. And I just don't have the same view that the second half is going to be so robust to make up for the Q1 and Q2 problems that continue to remain in the system, specifically in Asia. So then when we look at the jobs crisis in general, a third of the 69.7 million strong labor force in Africa's most populous nation either did nothing or worked for less than 20 hours a week, making them unemployed. So it's not, you also have this problem of where the labor is working and who is working. So it's not just an Asian problem, it's also an African problem. And Nigeria, just using that as an example of how these issues on labor continue to be on a global level, which is why when we look at purchases, activity, oil demand recovery, it's going to be a longer road given that people just don't have money to buy things. And that's why this slowdown is going to persist. So then when we look at India industrial production, so shifting back to India, we had a very large miss in terms of just what the contributions were. So when we look at January, on an industry side was down, mining, manufacturing, electricity was up. So the net contributions were down on the aggregate. So looking ahead, headwinds have increased in recent weeks on account of a rise in active virus cases, renewed local lockdowns in some states, rising input costs for firms, including higher oil prices, and surging borrowing costs, again, back to the 10-year. As a consequence, the recovery is likely to be a bumpy ride at best over the near term, despite both fiscal and monetary support. A sharp downside risk to 4.1% year-over-year GDP growth. Again, I think I've been saying for as long as you've been listening to me, the expectations for India GDP is too high. And here is it starting to filter through the system. In addition, output in the January to March 2020 base period was not revised down in the latest GDP estimates. This was despite the initial, the initial lockdowns. As a result, current quarter growth won't benefit from the low base that was expected because of just when that base effect kicks in. So again, India is going to remain a problem on industrial production, which we've continued to see in the consumption of diesel and the consumption of gasoline, which is, again, the leading indicator for what we know is coming overall. The other side is high frequency and early data for February point to a further slowdown. Employment fell slightly to 37.7% in February from 37.9% in Jan. The growth in goods and services tax collection declined to 7.4% year on year from 8.1%. They already have a massive fiscal deficit and tax receipts are coming down. The manufacturing PMI eased slightly to 57.5 in Feb from 57.7 in Jan. And non-oil exports growth slid to 3.5% year on year from 11.5%. All the while, inflation is going up. So this is looking at that 5.1% increase in CPI inflation after getting to 4.1. Now, they have the spread between 2% and 6%, and we're starting to get to the top of that range, and it's being driven based on what we're seeing with food. Milk and products up 2.6%. Excuse me. Fats and oils up 20.8%. Pulses and products up 12.5%. Again, miscellaneous, clothes, housing, everything is moving in the wrong direction when you're looking at Indian inflation. But when we think about current accounts, overall, it's not terrible when we're thinking about where we sit right now. Now, if tax receipts continue to fall, fiscal spending goes up, inflation goes up, this is going to change. But right now, when you look at just where the backdrop is, non-commodity services and income have been more than enough to offset the rise in oil prices and the rise in gold prices. So again, there's still this movement. I just think this is going to shift further up, and there's going to be further down, and we're going to see more pressure as non-commodities and services continue to contract just based on the demand we're seeing, or the lack of demand that we're seeing for diesel, distillate, gasoline, showing a slowdown in just industrial activity. So then when we look at, what does that industrial activity look like? India wholesale prices index year over year, we're at 4.2%. The survey was for 4%. India wholesale price index year over year manufacture of textiles is up 6.4%. So again, the prices are going up, which is just going to make the fiscal stimulus go not as far. And it's also going to just stress or strain the underlying local demand while they're trying to pass off some of these costs. So when we think about this overall and now shift over into what is happening in China. So beyond growth, modernizing the economy in China's goal for the next 15 years, contribution to China GDP from capital, which is they want to shrink because they've been using capital to essentially backstop growth. So they need to pull the capital out. But labor is becoming an issue. We've talked about the one-child policy issue, the two-child policy issue, the aging issue within China. There is a labor problem, which is going to become a much bigger issue over time. And that's why the total factor productivity growth, that's why they want to modernize manufacturing, because they need to avoid all of this. All the while, this is a very important thing. For those that have been following China as long as I have will appreciate why this is important. U.S. Secretary of State calls Taiwan a country. Country label for Taiwan breaks long-standing U.S. State Department taboo. Again, we have sold them Harpoon missiles. We have asked them to increase their level of semiconductor production. We have given them high-level IP, very state-secret IP. We have a known trip force now on their soil, and in regards to China flying bombers over their line of EEZ, we have responded by sailing through our carrier fleets. This should shock no one. If you don't know where we stand on Taiwan, you have not been paying attention. And this is why Taiwan is going to be an interesting point to see if it's even brought up in Alaska. So then when we look to just the Chinese data sets, it's, there's the data is skewed because of the base effect. So new home prices month over month were up 0.36%. Industrial production, which again is the positive, was up 35.1% versus the survey of 32.2%. Fixed asset investment, expected at 40.9%, came in at 35%. Again, future investment. Property investment was expected to be at 53.4%, came in at 38.3%, missed by a country mile. That, again, looking at some of the investment problems, that's when we start to look at what are some of the headwinds overall. Survey jobless rate was up slightly from 5.2% to 5.5%. Retail sales yield year to date, now, it beat estimates of 33.8% versus the estimate of 32%. But if you remember, the e-commerce numbers that were reported were north of 50%. So where did it go? What is missing overall? And it comes down to January. So January was slow. February was better. But when we annualize it and look at it month by month, they still don't have the local demand that they need or that they desire to try to not worry or not rely as much on the international market. So then when we look at what came out of the People's Congress. So what was the National People's Congress target in 2021? Real GDP growth over 6%. That can be done, but there's going to be pressure. CPI inflation has been increased to 3%. That is something that is going to be easier to obtain just given where the issues are in general. Fiscal deficit, they want to cut it to only 3.2% of GDP, which is going to be difficult to achieve just given where their current lending is. And we've talked about just how much money is going into the market. But the urban job creation is the biggest one right now that they want to get, that they want to incentivize, because this is a way to help decongest some of these cities, get people out, try to reduce some of that pollution, but also decentralize some of this activity. Because let's be fair, if you're looking at attacking the U.S. and attacking China, the U.S. is a very broad country with people living all throughout the nation. In China, things are very centralized. And not to say that this is a geopolitical, military-esque thing, but there's also a certain means of environmental, trying to get people to spread out, helps against the spread of viruses when you're not as densely populated. So that's going to be something to watch to see what that urban job creation looks like. Now, this just puts it into a chart on how massive some of this move was. But China's fixed investment, again, missed by 5.9% industrial output. But China property investment expected to be at that 53.4% out of that 38.3% is an important setup, because you can see that Retail sales were going slow, and then you had that spike up, but everything has been flatlining well below where we were pre-COVID. So PBOC on Monday injected 100 billion yuan to the banking system via 1 year at 2.95%, rate unchanged from the previous. There will be another 100 billion loans expiring on Tuesday. The central bank also injects 10 billion. So they're trying to slowly kind of pull this liquidity out. But again, they've had trouble doing it at a pace that the market has been comfortable with. Now, let's take the 2-year growth in actual versus pre-pandemic. So we've kept talking about what it is. So the fixed asset investment. So when we look at where it sits right now, pre-pandemic growth was at this white bar, and the actual growth is at the diamond shape in terms of where it currently sits. So when we exclude the base effect, fixed asset investment and retail sales growth slowed from December. So when we look at retail sales and fixed asset investment, you can see how much we missed once we back out some of this base effect, which again speaks to the supply recovery versus the demand recovery. Supply is going into the international market, but local demand just isn't there to support that, which is why they walk back some of that that GDP growth as well. So then when you take that, that backdrop, let's now break it down a bit more. Shenzhen and Shanghai banks are investigating whether customers have been illegally using loans to buy homes. Again, this is where we're starting to see this pressure on cracking down on some of this movement. We're seeing the slowdown in development, in industrial and retail and real estate, because they're trying to crack down on some of this. So the Shenzhen banking regulator required major commercial banks to investigate the flow of business and personal loans into the real estate market. The banking insider told reporters that similar investigations had become routine over the past 2 years, but things have gotten much stricter. Rather than do simple spot checks, banks are now required to inspect all companies and related individuals who bought a house and were approved for a loan since the beginning of 2020. So this is where that crackdown that we've been talking about since last year is coming back full circle. So the Shanghai branch of the People's Bank of China released a credit policy guideline for 2021, which called for preventing the flow of personal and business loans into real estate. That's why the real estate side, they want to cool off real estate, which is why that level of GDP growth is just coming down, manage prices, kind of bring this back under control, which is when we start looking at monetary policy. So the CRB is very sensitive to Chinese monetary policy. So the ebbs and flows of credits of China's total credit creation often lead to fluctuations in commodity prices. So commodity prices are going to continue to trend up. I know, shocker. But when we look at how China credit creation is starting to slow down, this is going to keep and cap some of that capacity because they're sitting on so much capacity when we look at what's in storage. So then when we take that to the next level and look at China's credit impulses and property prices, that's why when we look at credit impulses are rolling over and those property prices are trying to tamp them down, because that's when we're seeing that overhang. So consumption stood out for its weakness. Retail sales rose just 6.4% from the January-February period in 2019, with average growth in the 2-month period in 2020 and 2021 of only 3.2%. This performance was substantially lower than 8% growth for the full year in 2019, putting consumption well below pre-pandemic levels. Fixed asset investment was up 3.5% in the first 2 months of this year from the comparable period of 2019, with an average rise of 1.7% in the 2-week period in 2020. So the fixed asset investment was up, but that's the one that we continue to see pressure on in general. The average rate was below the 5.4% expansion in 2019. Fixed asset investment also stood below the pre-pandemic trajectory, with a narrower gap relative. So again, retail sales, fixed asset investment continue to see the pressure. Estimates also suggest that fixed asset investment growth decelerated in the first 2 months of this year from the pace at end of 2020. So not only is it low, it's going lower as we're seeing with this rollover. So China's cabinet will keep macro leverage ratio basically stable, appropriately lower government's leverage ratio. So they're trying to take down leverage ratios. President Xi will step up supervision of internet platform economy. So not only are they trying to ratchet down leverage ratios, but they're also going to continue to go after what that underlying economy looks like. So looking at this chart in general, we want to consider January, February data with the first 2 months continues to be a overall problem. So this huge gap shows just how lopsided and unhealthy the recovery continues to be. The sectors Beijing wants to see growing are barely limping along, while the sectors it wants to suppress are growing. To call this a strong recovery, in other words, suggests not only misunderstanding the Chinese economy, but also ignoring what Beijing is trying to do, which again has been beaten over our heads again when we look at the underlying data from the Congress. So then when we look at new loans, you can see that the Chinese new loans for 2020, the survey was for 950, the actual is for 1,360, or I should say 1.4 trillion. So you can see just the shift continues to go up. Even though they're trying to ratchet down new loans, they're still outpacing surveys. So then when we look at the Chinese import side, so the large increase in Chinese demand was a key reason behind the secular bull in commodities. But now we're starting to see some of that take and slow down as we talk about in the EIA show, and as some of the leading indicators continue to show out of the Chinese data. So when we look at some of the factors of crude oil, iron ore, and the shifts overall, we also have, again, that pressure that remains on the Central Commission of Financial and Economic Affairs. The CCFEA is the party's top body for deliberating economic strategies. So the healthy development of internet platforms is key as they go try to get away from some of the commodity heavy. They've already done that. They already have storage. Now they have to get bigger into tech, which is something that they've been driving for. So the authorities will increase oversight over China's large platforms, aka Alibaba, Tencent, and they're looking to expand anti-monopoly manpower and authority, increased oversight on the tech companies' financial businesses. Regulators will also require the platforms to do more to ensure product quality, user privacy, data security, employee rights. Xi said the platform economy is conducive to improving the efficiency of resource allocation, again, moving those resources around, and prompting the accelerated evolution of technological and industrial reforms towards informationization and digitalization. E-commerce platforms can no longer pressure merchants to choose one platform, open it up a bit. Non-compliance is punishable by a fine of 2 million renminbi. Xi just wants to make sure big tech is playing by the party's rules, which again comes down to the bigger issue in terms of how are they going to progress, because big tech prospers at the party's pleasure. So when we look at Hong Kong, you can see that Hong Kong's unemployment and underemployment have skyrocketed, and there's just nothing to say that that's going to stop as that continues to press up, which again is that underlying problem that we continue to see in the jobless rates and just the pressure that's going to remain within Hong Kong in general, which is just showing, again, some of these cracks in what the Chinese economy and what China is trying to achieve in general. On the positive side, rebar margins, HRC margins have gotten better. They've shuttered some facilities. They're still sitting on a ton of capacity, but the shuttered facilities have enabled some, or at least the rollback in production has enabled some margin to come back, which they still sit at a record amount or a near record amount of China copper smelters. Just looking at this, looking at the amount of rebar inventory. So margins have gotten better, but you're still working through a lot of inventory. So you're not going to turn around and try to suss out and do more. You're just going to try to let those margins get a little bit better while working through your inventory. Then when we look at iron ore, again, moving in that direction where it continues to accelerate. But then when we look at the India backdrop, because remember, China and India continue to have their issues. China is an importer of Indian goods, and India is an importer of Chinese goods. So this is kind of giving you an idea of where that pause is on the Indian side as we look at what is happening on trade in general, because trade continues to be a concern, especially coming out of Asia when we look at volumes and what does the next round of stimulus look like. And it's because let's just look at what is happening on the food side. So vessels carrying soybeans are increasing into China, which is again absorbing because there was that delay in in harvest, which is, you can see just the backdrop or the backlog from in December through February, which is why they're now starting to get released, which will start to show up as they go through the Strait of Malacca and make their way into China. All the while, the agriculture index soared to the highest level since 2014, putting additional pressure on countries that we've already talked about. And it's only going in one direction based on the absorption of spare product going into China, leaving others to buy more, which is when you start looking at Chinese imports have increased sharply. This just gives you an idea of what has increased. Corn has increased, soybeans, but soybeans is just getting started just based on the charts that we've seen, which again is going to continue to drive that higher. While all of this is happening, the share of government debt held by foreigners in percentage, when you look at what is China doing, what is Japan doing, foreign buying has slowed down. Now, it's not that it's slowed down precipitously, it's that the amount of debt the U.S. government is issuing is just not being met with an increased percentage of international buying. So we're just getting this cap in terms of what their activity is, and just they're starting to sell. They're actually starting to sell, or they were selling, now they're starting to buy a little bit. But again, this is looking at the issuance of U.S. treasuries versus demand by sector. International buying has remained sluggish, which is why we continue to see some of these rates going higher. But we're starting to get a little bit activity out of China, where activity is starting to buy a little bit more. And Japan is doing something similar. So China holdings of U.S. treasuries rose by $22.9 billion in Jan to $1.095 trillion, the highest level since October 2019. Japan holdings rose by $25.4 billion in Jan to $1.227 trillion, highest since August. So they still remain the biggest, but we have to look at what is happening in general, because respective totals of treasuries held by Japan and China are still more than the combined holdings of the next ranking countries of the UK, Ireland, and Luxembourg. Many among the top 10 are tax havens or financial hubs. So again, they've increased a little bit as rates have gone up, but it's not going to be enough without rates going further, which is going to put more pressure. All the while, U.S. corn exports surged, inspections since 1983, with China just announcing several million in bushels being purchased. So U.S. weekly inspections, we've crushed it again on corn and wheat, with soybeans going up. U.S. corn export inspections at 2.2 million tons, nearly broke an all-time record. That's the largest since 1989, but only 16% was bound for China. 31% of soybeans were to China. Wheat inspections were well above expectations. China's largest food company plans to merge its international trading division with several domestic businesses to create a new agricultural commodity behemoth. Trying to get pricing much? As they continue to be massive buyers, as China just bought a huge shipment of corn, I think it was about 32.2 million bushels, or I might have gotten that wrong, but I'll put that in the comment section. So then when we look, and we want to look at just what is happening and just rolling it all together, the new issuance of Chinese local government special bonds. So if you want to pare back spending and just what is happening on just lending out money, this is where we continue to see the problem of net issuance of Chinese local government special bonds is essentially flat. This is where 90% of tax revenue goes to financing these bonds. So you have a huge issue at the provincial level where they don't have money to invest anymore, which is why you keep seeing these new special purpose bonds coming to market. So just looking at that and considering what we're about to talk about, Zhao delivered the report on January 22nd during the CCDI's annual plenary session. The financial sector was in his crosshairs. We will crack down on elegant bribery, shadow shareholders, and other forms of hidden corruption. We will deepen anti-corruption work for the financial sector and strengthen financial supervision. We will urge the implementation of the regulations governing the conduct of leading cadres, families, and businesses. Efforts should be made to solve the problems of supervision over top government and party leaders. Xi's anti-corruption campaign is the widest-ranging, longest-lasting in party history. This is thinking back to Mao. It shows no sign of slowing down. So even though they're cracking down, they're still letting provinces feast because they can't stop, because there's so many issues on a debt level at a provincial, which also feeds back into the issues at the PBOC level. So then on Saturday, head of the Social Security Research Institute, they've in order to try to protect some of this, they're now extending the when you can officially retire. Again, increasing the age, that's putting more pressure on just when people are going to be able to retire, which is making people very angry. And it's not being taken well, but it's something that they have to do given their age population and the debt issue that resides at not only the state, but also the provincial level. So Lee is explicitly directed local governments to reduce debts. To keep the macro leverage ratio basically stable, the government leverage ratio must be reduced. We will closely track changes in the world and domestic economic operations, conduct in-depth analysis of new conditions and issues, and ensure timely adjustments and fine-tuning of policy. So they're forcing people to cut, but they're saying we're going to do it gradually, and that's essentially opening them up to feeding the beast if they need to, if they're missing those GDP targets. So ministries and localities will publish plans for implementing the government work report in the weeks to come. Local governments are under pressure. The central government expects them to do more with less, even though those bonds still remain grossly elevated, leaving a problem of they're saying one thing, but they're facing another. And that's something that we're going to talk about in a bit more detail. So I know we covered a lot. If you have any questions, please let us know. There's a lot happening in the Asian front, which continues to be that headwind to some of the normalcy that we should see in the oil markets and just the energy markets and just markets in general. So hopefully you had a great St. Paddy's Day. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.